Ladies and gentlemen, a very warm welcome to you on Business Today Television. It's the first week of a fresh year and the markets have already hit a record high, at least as far as the two major indices are concerned, Nifty and Bank Nifty. But what does the crystal ball hold for the rest of the market, and what will be the eventualities that are most likely to happen over the next 12 months? To discuss this and a lot more, we are now joined by Mr. Ravi Dharamshi. He's the founder and CIO at ValueQuest Investment Advisors, a very well-known PMS in the market over the last decade and a half or so. Mr. Dharamshi is also one of the major stock pickers that we have often tracked on Business Today over the last 3 years or so. Namaste Ravi ji, a very warm welcome and a happy new year. The markets have stepped up the gas as far as the Nifty and Bank Nifty are concerned. How do you see 2026 after a very painful 15-18 months for Indian equity investors?
Namaste, good morning, and thank you for having me on the show, and wish you and your viewers a very happy new year. Thank you for having me. No, absolutely, you're right on the dot. Last 15 months have been very tough, especially for the broader markets. Even though the headline indices have been kind of in a range and now seems like they are breaking out of range, but the breadth of the market, the mid and small cap space, has been suffering quite a bit since the last 15 months. Not only that, relatively, India has been one of the worst performing market as compared to the world. Almost the extent of underperformance was to the almost 30%. So in a year when emerging markets actually did very well, India was one market that stood out in terms of an negative performance or underperformance as compared to the world. The reason for that clearly was that our starting point valuations were very high as compared to the rest of the emerging markets. The other emerging markets were quoting very cheap, and not only vis-a-vis India but vis-a-vis the developed markets as well. So money has flown into emerging markets, and India should also be eventually an beneficiary of that trend. But last year that's not been the case. Valuations now have reached a point where you can say they are not as demanding as they were maybe 15 months back, and the cycle is not at a stage where you can say that there is a bubble and we are about to burst. So no doubt valuations still remain elevated, but relative valuations have become attractive. And if there is continuation of the cycle, which I do believe that the cycle will continue, then this is a great entry point from the point of view of making money. Why do I believe that cycle will continue is because government and RBI both have changed their stance dramatically. They have become pro-growth. They have taken the focus away from fiscal deficit, fiscal consolidation, and focus is not on managing inflation or managing rupee dollar volatility. Focus is on providing liquidity to the banking system, bringing growth back, relaxing regulations wherever necessary to push the credit growth. In this kind of a scenario, very rarely will markets collapse. So from that perspective, cycle is on the verge of an uptick, and so is the market. And already the headline indices are pointing in that direction, but the broader breadth of the market might still take some more time before they start performing.
Right, sir. Fair point. So let's start with the basic premise that you are more hopeful for 2026 to be much better than the last 15-18 months that have been relatively painful. Before we proceed further, Mr. Dharamshi, what are your expectations from the budget, which is now just about 20 sessions away? Mostly what the government could do possibly in terms of reducing interest rates, cutting GST costs, and of course providing a very strong thread ahead is the RBI. Now, what do you think are the 2 or 3 major steps that the government can take to benefit corporate India and capital markets during the budget next month?
Yeah, no, so first of all, we need to understand that budget incrementally has been less and less an impact on the markets. Not to say that it still has importance and it will continue to have importance, but lot of steps tend to be taken outside of the budget. So the incremental impact of budget tends to be lesser and lesser. But having said that, what markets will be looking for is continuation of policy. See, we have been in a this will be year 12 or budget number 12 of this particular government, and this is the longest period post our capitalistic adoption of capitalism in 91 that we have had the most stable policy framework, right or wrong, whatever, but it's been very stable. So from that perspective, this government of the day has always been focused on managing the balance sheet and always been focused on supply side reforms. Last year we saw incrementally some change over there, where income tax cuts were announced and direct tax as well as indirect tax cuts were announced. Now this is the first time that some sort of demand stimulus was also given. It is an admission of the fact that central government capex driven economy had run its course. The impetus given during COVID had run its course, and there was a need to provide some kind of a stimulus for the cycle to continue. And that's exactly what the government has done. And I do believe that continuation of those policies, incrementally consumption oriented policies, incrementally spending will be there from the central government, but it will remain more targeted. It cannot be the needle mover. The year from 21 to 24, the capex growth was almost 25-30% in the central government's budget. That will not be the case. This time we are anticipating somewhere between 8 and 10% kind of central government capex increase is a more sustainable number going forward. So it will track the nominal GDP growth rate rather than exceed that. So other engines of growth need to be fired up, and that's what we will be looking for from the budget, that more and more new engines of growth get fired, whether it is the broad basing of the real estate cycle, whether it is the consumption cycle, whether it is the rural economy. Those kind of engines, if they get fired up, then the cycle can continue forward.
Right. Raviji, what are the one or two sectors that you are looking with the great hope for 2026? They may have already shot up, but still provide some opportunities on the long side.
So unfortunately for us, markets don't follow the calendar cycle. So it's not that on 1st January something will be available which will do very well till 31st of December. Some of the sectors have already started doing well. If you see, metals are clearly one area which has done very well, because it's primarily led by the fact that industrial metals have started doing well, whether it is aluminium, copper, silver. These metals have started doing well. So any stories related to metals, whether it is the converters or whether it is mining plays, they have started doing well, and derivatives of those will also continue to do well. Second area which we believe should do well and has already started doing well is the financials. Within financials also, essentially the call is that there will be releveraging in the economy, whether it is at the household level or whether it is at the corporate level, and that will lead to, and if you have a regulator who's very, very pro growth, then it's only a matter of time where the growth bounces back. So last year our credit growth fell from 15% to 9%, which has now bounced back to about 11.5%. I do believe there is scope for this 11.5% to go back to 15% kind of a growth rate over the course of next 12 months. And that should mean a good performance from the lending stocks. So whether it is banking or NBFCs, both are likely to do well. Currently, it is more NBFCs because we are still in a rate cut cycle, and in a rate cut cycle, NBFCs tend to do well. I do believe that rate cut cycle should end maybe with another 25 or maximum 50 bips cut, and that should lead to peaking out of the NBFC cycle, and banking cycle can start doing well after that. And already it's not, banks are the growth is the only challenge. If you see, the asset quality is not an issue. Fund balance sheets are quite well capitalized. So from that perspective, only NIMs and growth were two things that to be considered. NIMs have bottomed out, and if growth has also bottomed out, then the stocks also should start doing well. So financials and metals are two areas which have already started doing well. Third area, which I do believe, because of the steps taken already and the steps anticipated, consumer oriented stories should start doing well. I do believe that last 3-4 years their stocks have not done very well, and they have reached kind of a trough over there. And with the indirect tax cut and the direct tax cut, and with the interest rates coming down, it should give spur to some kind of a consumption cycle. And with next year the pay commissions lined up, there is a possibility that that consumption cycle continues. But the real driver of the consumption cycle will have to be the fact that private sector capex cycle picks up. If private sector capex cycle picks up, the job creation happens. Usually with a lag of couple of years after private sector capex cycle pick up, consumption cycle kicks in. So those are the things that we are looking forward to for the consumption cycle to. This year might be a year one, but the real consumption boom might be 2 years away, is what I feel.
Okay. Raviji, which are the sectors or spaces which you don't think merit attention at this point of time, despite the cleanup in valuations, despite a very sharp correction in stock prices? What doesn't look good to you?
So, one thing that worries us, and we are not yet clear on how things will pan out, is the IT services sector, especially because, first of all, this is a mature sector. It is a large sector, and the growth rates have already tapered down to single digit. Now, with the secular headwind of AI, not really sure on how IT companies adapt. The fact of the matter is that IT services company have not invested enough to seed products or platforms, and that is a disadvantage, and there will be a transition period. Even if they want to adapt at this point of time, there will be a transition period. Some of the companies are trying to acquire, and acquisition can be a short-term panacea because that will help growth in the short run. But in the longer run, I think IP-based growth is what one should be looking for in IT services companies. So we are within technology, we are focused more on companies that are creating their own platform or IP. That is what will give us a longer term, protection from the AI-led disruption.
Okay, fair point. And a view on the rupee at this point of time. Of course, are you a proponent of this debasement theory also, which is pushing metals, especially the precious space, very high? Is the fall of the rupee now more or less done? What would be the prognosis for 2026?
No, so see, there has been clearly a change in stance from the RBI. If you go dial back 3 years, there was a period for almost 2 years where rupee was very contained in its volatility. In fact, the volatility was killed, and the rupee remained stable between 81.5 and 82.5 for almost a 2-year period. But what that led to was, because of the excessive focus on rupee volatility and inflation, we ended up running into deficit in the banking system, and that hampered the growth. Now the priority has clearly changed towards growth. So RBI is saying that we are going to let the rupee depreciate and focus on growth and focus on managing the banking system liquidity. So rupee is at the mercy of the it is at the mercy of flows, whether it is the foreign flows or whether it is the FDI or whether it is the trade. And on that front, at this point of time, the flows have not been very positive for India. So rupee still remains under a little bit of pressure. It still remains under a depreciating trend. From a longer term perspective, I do believe we are trying to correct the trade deficit as well as the fiscal deficit. And if we manage to change that by bringing down the electronics imports, by bringing down the gold, silver imports, or by bringing down the energy imports, if we bring that down, that should change materially and dramatically the longer term structure of the rupee depreciation. That assumption that we have built that every year 3 to 4% rupee depreciates will come into question at some point of time, but that is not the case as of today. Today we still remain under a depreciating trend, and RBI is absolutely okay with depreciation. Only thing is, it might come in to suppress the volatility if it spikes too much. So yeah, I mean, So exporters with will benefit a little bit in this quarter as well as going forward from the rupee depreciation.
Okay, fair point. Any thoughts that you would have on the broader market, which is the traditional FMCG pharma sector? We haven't had any kind of activity on the long side in FMCG pharma, and in particular the cement space. Are they offering opportunities for long-term stock pickers such as you, in particular cement?
No, so I think cement definitely it's gone through almost a 10-year period where there has not been any significant addition in the capacity. Growth has also been a challenge, but I think now with the call being that cyclically the India's GDP growth picks up, the cement should also be a beneficiary. But cement cycles are usually led by supply side, not by the demand side. Demand remains steady and growing, but it is the supply shock which creates. I think now we are reaching a point in time where adding new cement capacity is becoming a challenge. You will not find new limestone resources. You will not be able to put up a plant very, very quickly. So and if we continue with the infrastructure investment that we are doing, there are two main drivers of demand. One is the infrastructure investment and second is the real estate cycle. Real estate cycle last 3-4 years has not been very volume based. It has been driven primarily by luxury, and that is not very high volume. So for the cement cycle to do well, the broad-based housing cycle needs to also pick up. And I do believe that the stars are getting aligned for that to start picking up. So yes, cement remains an area that one should be looking at, and there has been a lot of consolidation in the sector. Now I think the top 3-4 players combined would be controlling almost 60-65% of each regional market, and that brings a lot of stability to the sector. And so yes, I am more favorably inclined to look at it at this point in time, though we as a disclaimer, I mean, we don't have any exposure currently, and we have to keep from the point of view of the cost also, the crude prices being low and stable is actually a positive on the cement sector. So that is one more positive in the cement. Coming to pharma and FMCG, I think pharma is no more the traditional last 20 years. It's been US focused generic story. That story, at least in the oral solids, has come to an end. That horse has been flogged quite a bit. Now the next level of growth will come from complexity, addressing complex drugs, specialized drug, biosimilars, inhalers, or GLP-1, semaglutide. Those kind of niche areas are the one from where growth will come in the pharma space. Or now there are new emerging stories like healthcare services, whether it is single specialty hospitals or multi-specialty hospitals or diagnostic chains. Those are also now becoming part of the broader healthcare sector, and those are the areas where you should probably be looking for opportunities rather than the traditional US focused large generic pharma companies, because for them generating new growth becomes incrementally a bigger and bigger challenge. More money needs to be deployed. They need to start taking risk and go after NCEs, which is new chemical entity, essentially innovator drugs, and that is a long game. It will take time to fructify. It is not easy.
Okay, fair point. With this thought process, Raviji, let's call it a day. And here's wishing you all the best for 2026. Let's hope the pain that all of us, including mid-cap and small-cap stock pickers such as you, have experienced in 2024, 2025 fades away, and that we bring in a new dawn and better earnings and better results for 2026. Thank you for your time, sir.
Thank you so much. Thank you.
That, ladies and gentlemen, was Mr. Ravi Dharamshi. He's the founder and Chief Investment Officer at ValueQuest Advisors. Thank you for watching. Please stay tuned to Business Today Television. There's a lot that's happening in the first week of calendar 2026 that's worthwhile on the long side. Have a nice day.